Where do you want to be across asset classes right now?
I still think you want to be invested in equities. I think more cyclically oriented equities, particularly those that are exposed to commodity inflation, is really what's going to outperform as we move from mid-cycle into later cycle environments.
And Erin, but does it, I mean, I'm just taking a look at what we saw in the third quarter, where clearly you saw stocks and bonds were out of favor, yet commodities outperform as well. Does this put to question the whole 60-40 strategy portfolio now? Is that no longer attractive in these markets?
No, I definitely think it still is attractive in these environments. I think with respect to the 40, what you've seen is, duration has moved off the lows. I do expect that duration from here is likely to be more range bound, but in real left tail scenarios where you see, significant risk being priced back into the market, bonds still perform like they should as a hedge against your risk portfolios. So you don't want to abandon the 60-40 portfolio, but you do want to start to take on more inflation hedge risk exposure in the portfolio, either through commodities or through cyclical equities.
Erin, what lens are you looking at China through? We've heard from three houses, Soros, Man Group, and of course Elliott as well. They're saying that they don't really see any reason to invest any more at the moment, and it's a wait-and-see game. Or what's the deal for you?
I think wait and see is the right approach right now. Valuations have become very attractive, particularly if you look at Chinese assets relative to other global assets. And so there are selective places, whether it's in the tech sector within China or specifically within, some property bonds, which still look attractive within China. But you probably want to wait to get more clarity in terms of what the regulatory regime is going to look like before you can really, dip your toe in and start to buy those assets. So looks attractive, but right now we're in a wait and see mode.
All right. Now, so in terms of geographical preference, so the U.S., you like Japan as well, but you're cautious on Europe. Tell us why.
Right now, you're seeing inflation risks really start to percolate. And I do think that you're going to see that really eat into margins as we go through the fourth quarter into 2022. The energy crisis that's starting to loom in Europe, I think, is a real risk that is being, underestimated by the market right now.
Absolutely. And does that then shift you to what you term real assets, as it were?
That's exactly right. And that's why I think you need to have more commodity exposure, more inflation exposure in the portfolio. Owning real assets is a good place, whether it's through real estate, whether it's through commodities. I think both are well positioned to really outperform in this environment.
I saw you're neutral on the U.S. dollar as well. I mean, this is given at a time where we are seeing a lot of tension in the markets and people are kind of going into the greenback as a haven currency. Also, people say if you're going to kind of price in some kind of tapering, that transmission mechanism is going to go to the dollar. What makes you have a neutral view on it?
Well, I think the dollar right now is going to be, is probably likely to outperform relative to other developed market economies, but probably underperform a little bit to some commodities or commodity-oriented currencies. So broadly neutral the dollar, I think versus DM, you see the dollar probably be range bound to slightly stronger versus some more EM oriented commodity currencies. The dollar could weaken a little bit, but I think that there's better alpha trades right now rather than trading FX. I think you probably do better trading equities in this environment or trading commodities in this environment.
Okay, yeah, so let's look at rates then, because you have two things happening. You have some EMs well within their tightening cycle, so that's creating some carry opportunity, but you're coming up against the taper wall. Is that window of opportunity closing on rates?
I think that right now you're likely to see, specifically if you look at the 10-year, it's probably likely to be fairly range bound over the next year or so, with a slight bias to underweight duration, particularly in terms of nominal yields. Real yields, I actually think will remain fairly well bid, particularly given the fact that you're going to see inflation, I think, rise from here and people continue to break even inflation. But nominal yields will follow that path somewhat. But I think real yields will actually remain fairly well bid, particularly in light of the fact that central banks, while responsive and gradually starting to taper, are going to be fairly reluctant to really get ahead of the moves and still be fairly gradual and patient in terms of their path plan in terms of normalization.